Hi everyone, welcome to my YouTube channel. My name is Tabitha and today we are going to talk about Vanguard. Today we don't have the slide prepared for you, but I will just go direct to the company website so I can give you the real stuff, not the notes that I'm bringing all the time. So this is the stocks that we're looking for today is VDY, which is Vanguard, the High Canadian Dividend Yield Index, which is ETFs. So this ETF is mostly Canadian and is traded in the Canadian stock market, which is TSE. So first of all, you have to look at the market value, which is the price per share is 49.38 per this time. And you also look at the MER. The MER is the management fees that they charge for holding that stocks. So the yield in the past 12 months is 3.91%. So which is really very good for this fund. And it's made up of many companies. So most of the time, the objective of this fund is to track the high dividend yield index ETF. So they track these high dividend companies and then make it into one fund, and this fund pay you monthly dividend every year. So they pay you monthly dividend. So those are the things that you should look at. Why are you taking this fund? Because it track the highest dividend paying companies, which are also stable companies. Things like this thing Enbridge and financial like BMO, all those stuff. So the management is also passive, so you don't get involved in whatever they do. They just charge you that small amount of 0.22%. So if you are someone who want that freedom of not being so involved in management of your portfolio, and then you can take that fund. Also efficient, it's cost effective because management technique are very they are not costly. The fun facts about this ETFs is that the total asset under management is 3.43 billion. Yeah, so it's 3.43 billion. So that's a really good highest number. So, and this is the total number of holdings. So total number of holding is the total companies that are in that fund. So the the big name in Canada economy are the ones that make up this fund. So it make up of 56 holding. So when you come here, you can come and now check distribution per unit. So what do we mean by distribution per unit? So these are like it's the amount that they pay per share every month. So which is 0.19. So it's like 19 cents. So you get 19 cents per share, which is paid to you monthly. So if, for example, you have 10 shares of VDY, you will get $1.90 a month. So if you add more and continue investing, and then you will make more money holding VDY. So majority of people like to buy this VDY when the price is down because it's very expensive stock or fund ETF. So you have to wait until the price goes down because the less the price is, the more shares you own. And when you have more shares, you will get more money because we are paid 0.19 per share. So that is the fun facts about that. So when we talk about the total returned net fees, so this is what it look like. So the quarterly. So you can interpret that one by looking at this, the benchmark, the market price. This is the market price. It's the benchmark. is NAV in Canadian dollar. So now let's go down and move and look at what is more important. So for you to really, if you want to invest in a fund, so most of the time you have to really see how it has been performing for the last 12 months or maybe in the last 3 years or something like that. So when you look at this one, it's the growth of the VDY over time. So in 1 year, so in 3 years. So mostly, even if there's up and down, the trend is upward, is exponentially upward. So even in 5 years time. So the curve is going up, which is continuously growing. There are those short-term down, up and down, up and down, but those one does not, they do not really matter because you are investing for the long term. The short term price fluctuation does not really matter. You're building passive income. So it will go down, it will go up, and it won't really affect the amount of dividend that you had. Maybe slightly, it will just adjust and then go back to normal. Because the number of shares do not change when the price goes down. So the more you can buy more when the price goes down and continue building for your passive income or getting more dividend from the one that you are investing in. So now let's move down here and look at the thing. This part is not that much important because we are investing long term. So if you are investing long term, the risk is spread over a long period of time. So it doesn't really make that much difference. So look at the market capitalization. So this one, so the geographical market capitalization of this one is, so you have the largest. So you see the largest amount, the medium one, the small, medium. So that's how it works. So there are some companies or some industries that hold a higher percentage while others hold a small percentage. It's not evenly distributed. So now let's look at the allocation. So the allocation here shows that it is only Canadian market, which is North America, is 100%. Most of the companies found in this fund is Canadian. It's 100% Canadian. So it's not much exposure to regional market or international market. So region exposure here. So it's North America, Canada. And then here, the weighted exposure. So when we look at the fund, it's made up of 56 companies. So these companies are spread all over the industries, right? So in this case, we have to now learn about financials. So this company, this fund hold most of 58%. Financial hold 58%, energy hold 28%, utilities, and then telecommunication, and the rest goes small as it disappeared, right? So this is very important when you are picking up the fund that you want to invest in, because the distribution will really let you know if you are, how much percentage you are putting in different sectors of the economy in that fund. So it's just that way. So it's weighted exposure, it's financial, higher, energy, and then utilities as you go. Now let's look at the companies that are top 10 holdings. So just like the way we were like doing it before. So when you look at the we have the Royal Bank of Canada, Toronto Dominion, Enbridge, Bank of Montreal, Canadian, like all the names that you can get that hold up the Canadian economy. So all of them, they're here. So TC Energy, Suncor Energy, Manulife, Canadian Imperial Bank of Commerce, Bank of Nova Scotia, Canadian Natural Resources Ltd, the Bank of Montreal, Enbridge. So all these are here, and they're all Canadian companies. So those are the top 10 holding. So all these companies, they pay high dividends, and they are Canadian dividend at high paying companies. So the safety is there, right? There are companies that have been in business for a while and all those, and they are the backbone of the economy. So it's a very good fund for you to invest in. Majority of people from Canada, they invest in this VDY. But all in all, you just have to do your own due diligence and see how it goes from there, because you have to have a reason why you are investing in that fund. So this one doesn't really matter. The price analysis, it goes up and down like any other stock. And distribution are always monthly. So they have ex-dividend date, they have record date, they have the payment date. So like last time, we were paid on February 10th. And then next month it will be scheduled and it will be like that. So the cash distribution is 0.19. So per share, you get that one. So if you have like maybe 100 shares, if you have 100 shares, maybe you have like 20 or something like that. So you have to invest when the price is down, so you can really see that significant change in the amount of dividend that you get every month. So that's about it, and we will look at a different fund later if we want to add onto our portfolio. Now we only have the Vanguard VDY, and we also have XEI. So we'll build on those ones for now until further notice. Thank you for watching, and see you next time.